This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
There was recently a front page Chicago Tribune article, and it had this title. It said, 98-year-old had good life, gives away $2 million. And it turns out it was the story of how Russ Grammel, an attorney who never married or had children, turned a $1,000 investment in Walgreens, this is Walgreens stock, into $2 million, but it took him 70 years. He owned the shares for 70 years. Now, Walgreens is a Chicago-based company, and there are a lot of them around the Chicagoland area and in the neighborhoods. So even 70 years ago, this would have been a name that Mr. Grammel would have been familiar with. And he says in the article that's why he decided to invest with them, because he felt like the drugstore part of it and just all the items they sold, that they're going to be around a while. And it turns out they were. So he was an investor. He talks a little bit in the article about how his family lost a lot of money in the 1929 stock crash. And he decided not to be some kind of trader, but he was going to be an investor and buy and hold for a long time. And it turns out a really long time. He decided to donate the money while he was still alive. Again, he's 98. He's still with us. And he donated it to the Illinois Audubon Society. He actually donated the stock itself, and they sold some of it to buy a 395-acre property, which is going to be used for just people to enjoy nature, basically. That property has 170 species of birds as well as rare turtles on it. So that's a real nice gift. But a couple of us were talking about this story in the office here, and that $1,000 was a lot of money back when he bought these shares, but that's equivalent to about $11,000 today. So it's a nice little investment that he put in there. But I'm bringing up the story of Mr. Grammel because he is an example of the ultimate buy and hold investor. And I consider these kind of stories to be like the lottery success stories of investing. There was another one here in Chicago a couple of years ago. Some of you might remember this story because it did go national, about a woman who worked as a secretary at Abbott Labs, which is in the northern suburbs of Chicago here. She worked there for over 50 years, and she got a lot of stock just from working there. And when she died, she had an estate over $1 million that like no one knew about, just mainly from buying and holding that stock. So what do these stories teach us as investors? Obviously, compounding is powerful. And these stocks, both Abbott Labs and Walgreens, pay dividends and have for many decades. So when you buy a stock that pays a dividend, even if the yield isn't all that great, it's basically, paying you out. And if you're reinvesting that dividend, which I'm assuming Mr. Grammel did, although the article didn't say that, but I'm assuming it did, then it just compounds on itself in addition to any gains in the stock. And that's a powerful thing. But in the last week since this article came out, I also saw other articles, piling on about this story. And some of them seem to imply that somehow Mr. Grammel followed Warren Buffett's rules, and that's why suddenly he had $2 million. And I thought that was kind of interesting, because what would that rule be? That you should buy and hold a stock like basically forever? Is that the Buffett rule? I mean, Buffett has some like other things that he does follow, obviously buying value stocks, and he likes certain brands and other things, but just owning forever didn't seem to be one. Although Buffett is famous for saying the time to sell a stock is never, but it doesn't mean he hasn't sold stocks. So I don't think Mr. Buffett would actually tell anyone to buy just one stock and hold it for 70 years, because that's what Mr. Grammel did. And he basically got lucky. No one wants to admit this, but he just happened to buy the right stock 70 years ago, because he could have bought something like Montgomery Ward, which was the number one department store at the time 70 years ago. He could have just bought that stock, or he could have bought Sears, which is also headquartered here in the Chicagoland area. And there's a ton of Sears stores everywhere here. He could have been like, oh, I love that. They're not going anywhere. And look at them now. Like, obviously, the iconic names don't necessarily stay iconic in any type of business that's just retail, but a lot can happen over decades. Management obviously changes, technology changes. Think of Xerox and like Kodak and those companies that have been decimated by technology changes. And then even something like a bank, we thought those were safe until 2008. And then some banks that had been around over 100 years or just decades, like Bear Stearns, you thought, and most investors thought, oh, they can't go under. And then they did. So Mr. Buffett, he holds some stocks for a long, long time. He's owned Coca-Cola for decades. There's a couple other big names. He's owned Geico. He loves the insurance companies, and those he's held for a long time. But he recently did admit that Berkshire Hathaway sold a large part of that IBM stake. I've talked about this before. And he said it was because the company that he bought no longer exists, basically. It's changed. And so that's why he sold. So the big question is, can you buy and hold for forever? Or even should you? And my answer to that is, sure, you can buy and hold for a long, long time. I've told the story many times of my grandmother who inherited some ExxonMobil stock from her dad. And she's owned it ever since, as well as her sister has. And she's 97 now, and her sister's 95. They still own it. But again, I feel like they got kind of lucky. They didn't inherit General Motors stock or some of these others or some airline that went under. So they just kind of got lucky in what it was that the one stock that they have been holding for decades. So my advice is you can hold for a long time. I've held some stocks for over a decade now in my own portfolio, but you have to keep evaluating. You have to check out the company's finances. Is it still innovating? Is it in an area that still has growth? And one good way to evaluate is by using the Zacks rank. Look for those rising earnings estimates and look for earnings growth. You can also go on Zacks.com to find companies that are actually growing their earnings. And as a value investor, then you can apply a valuation to it and get something that is in, lower valuation that you want. Now, Walgreens shares, I looked this up, are up over 5,000% since 1985. That's just as far back as the Yahoo Finance data goes. He obviously owned this stock decades even before that. And he's held through bear markets, through the 1970s awful market, and then obviously in the 80s and 90s, the mega bull, then we just had a bear again. So he's been able to ride out the waves, and as a result, Walgreens has done well. But what if you're looking for a long-term investment type of play for today? What if you have, $1,000 or the $11,000 and you want to put it into something and kind of just leave it there and watch it grow? Obviously, nothing is guaranteed, but I ran a screen looking for Zacks 1s, 2s, and 3s, so I kept it pretty broad. I looked for PEs under 18, so I went a little higher than my usual 15. But I was surprised at what I got. Actually, I got a lot more cheaper stocks than I thought. And I did that because S&P is trading around 19. So I wanted it under the S&P, but I wanted a little higher than 15. And then I looked for earnings growth of 10% and a dividend yield over 1, because that dividend yield is key in the compounding if you're going to buy and hold. And I found 5 very interesting stocks that are growing the earnings. Some may have staying power. Some have been around over 100 years already. Of course, again, that's no guarantee, as we've seen by some of the names I just mentioned, like Sears and Kodak and these companies, but they're doing well right now. So let's jump right into what I found, because I think they're interesting. So the first company is Tyson Foods. And I know what you're thinking, like, oh, a lot of these are going to be boring, Tracey. Well, no one ever said Walgreens was, the life of the party either. Maybe they did 50 years ago, actually. But now if you said hey, you need to be buying Walgreens, I don't think anyone is jumping up and down. It's not the Tesla. But again, that's sometimes where you find these hidden companies that are just going about their business and doing what they do really well. And that translates to the shareholder. So Tyson Foods is the first one. Ticker is TSN. They are one of the largest beef, pork, poultry producers. But what's good about them is they've also diversified by getting a lot of prepared food brands like Hillshire, Jimmy Dean. They own Ballpark. So that business is kind of stable. So if the prices of the poultry and beef are going up and down, and that they're getting hit on that, or there's, some bird flu thing or whatever, the prepared food side is more stable. So they have a PE of just 12. They're expected to grow earnings by 14% this year, and they have a dividend yield of 1.5%. Now, over the last 5 years, those shares are up 248%. So that's not too shabby for, kind of a boring food company. But some people might not say they're boring. Obviously, the S&P during that 5-year time period is up 82%. So you can see 248 versus 82. So that's the first stock, Tyson Foods. Our second stock is Thor Industries. I think I might have talked about them before. They've kind of been all over the value area recently. Their ticker is THO. They make the motorhomes, the RVs, and we've seen record demand for RVs. Last quarter, their third quarter was a record, sales up 56%. Those baby boomers are retiring. They're going to the open road. Gas is cheap. Everybody wants their, dream to drive across America. And Thor is really crushing it now. So their PE is 15.5, so not too bad. They're expected to grow earnings by 33% because we're seeing these record in the industry. And their dividend yield is now 1.3%. These shares are up 346% over the last 5 years. A lot of it has been in the last year as everybody's finally caught on to the story and that the industry numbers are showing this huge demand. So a lot of it is just in the last year with them. Our third stock is the NASDAQ, and that's ticker NDAQ. And a lot that goes on with them is with the trading volumes, which have been down. With this record low volatility, trading, people just aren't doing as much of it right now, but they're managing to still run the business really well. They just increased their quarterly dividend by 19% and they're buying back shares. Their PE is 17, so a little bit pricier. They're the most expensive stock that I'm going to tell you about today. They are growing earnings at about 12%, and their dividend yield is now 1.8%. And those shares are up 255% over the last 5 years, again, versus S&P at 82%. Our fourth stock is MetLife. The ticker is MET. You knew I'd put an insurer on here, right? Because the insurers just kind of go about their business both on the healthcare side and on the home, auto, life insurance side, which is what MetLife does. They are big in employee benefits. They have 100 million customers, with most of the Fortune 100 companies use them. They were founded in 1868, so they've been around quite a long time. The last 5 years, the shares are up 106% versus, again, S&P at 82. They're cheap. PE is just 9.9. So we got an under 10 PE here, which is very cheap for this market. Earnings growth of 16%. And the dividend yield is 3% with them. So don't overlook the insurers. I know a lot of you think, again, they're boring, insurance. But the insurers are kind of like a secret out there that value investors definitely should keep on their list, as Warren Buffett knows, because he's owned one or more for many years now. And turning to our fifth stock, it's Celanese with the ticker CE. CE is that one. They have a PE of just 12. They're expected to grow earnings 10% this year. They're paying a dividend yield 2.1%. They are in specialty chemicals. They're about a little over 100 years old, Celanese, founded in 1912. And their 5-year return is 175% versus 82 for the S&P. Now, remember, past performance is no guarantee of future results. So I've given you the 5-year. We've been in a bull market for a couple of those years. And so obviously a lot of stocks are up in that time period. But you'll also notice that there aren't any tech firms on here. So if you're going to stand the test of time, you basically need to be in the basics: food, insurance, chemicals, finance. These are the areas, the building block areas. That's why Warren Buffett also likes them. And if you're going to own something that you want to buy and hold, building blocks are a great place to look. Also remember, keep evaluating the company, again, because the businesses can change. I'm a fan of buy and hold, but I'm also always looking at that business. It takes a lot of guts to be Mr. Grimmel and own one company, if that's all he owned for all those years. Even if, to own for 10 years takes a lot of guts. The average investor holds for only 3 years. So anything above that, you are definitely a buy and hold type of investor. Remember to be diverse, own a basket of stocks. Don't just own one. That's too scary. He got lucky. You may not. So own a basket. And remember that buy and hold can be a powerful tool for the value investor. Always keep reevaluating because you don't want to get stuck in something where the story has changed. So let's recap those tickers again. Tyson's Foods, TSN, Thor Industries, THO, the NASDAQ, NDAQ, MetLife, MET, and Celanese, CE. So this is a few value stocks. Although one of them, the NASDAQ, it's close enough. We'll call it a value stock wannabe for now. But the rest are truly value stocks. And buy and hold is definitely a strategy. Keep it in mind. And I'll be back next week with some more value stocks. And in the meantime, you can check out all of our podcasts on Apple Podcasts, which is on iTunes, and on SoundCloud. And until next week, I'll see you then.